The focus that we've seen in recent weeks at the 1300 level in gold and the importance of that level was highlighted yesterday when we broke through. The dollar had been on the rise, not least against the yen, but also against the sterling, and that triggered the additional selling in gold, which eventually took it through, and we saw the traded volumes on the futures exchange surge to very high levels, more than double of what we normally see on a normal day in gold futures. We dropped more than 3%, the biggest one-day drops in almost 3 years. Most of the move has been long liquidation. We've highlighted how hedge funds have been stubbornly holding on to net long positions, and that the 1300 level potentially could be the initial line in the sand through which they would reduce exposure. That's what we're seeing at the moment, and the big question obviously now is, have we seen most of it, or could we see some continued weakness from here? First of all, from a technical perspective, we retraced 61.8% of the rally that we saw from May up until July. That is quite a significant level, and one that really needs to hold at this stage. Below that, we really only have the pre-Brexit low at 1250 to support the market before some additional weakness. So at this moment, we're holding on to significant levels, 1267 that is, and today we've seen the market just bounce a little bit. Over the coming days, we will keep an eye on several things. First of all, the open interest in the futures market will give us an idea about how much long positions has been reduced in the market, or how much the futures traders have exited from the market. Also, the ETF flows will be important. We have to remember back in May when gold corrected last time, we fell from 1300 down to 1200. During that month, futures exposure was reduced sharply from funds, while at the same time the demand for ETFs continued to rise. Over the past couple of days, we have actually seen a small pickup in demand for ETFs, not on a big scale, but we will have to see over the coming days whether that picks up or not, and that could be a potential sign whether this is just a correction in an overall bull trend. So what are we looking out for in terms of levels? Well, as I mentioned, 1267 is the key. Below that, 1250 is the last is the next level that needs to hold in order to prevent the move back down to the May low at 1200. On the upside, well, we need to make it back above 1300 to call this sell-off only a correction. And obviously, at this stage where we're trading around the 1272 level, we're quite far away off that. So we'll probably see some additional selling in the short term. As I mentioned, hedge funds reduced position by 33% back in May. We have seen nowhere near that reduction so far. That could potentially just add some pressure in the short term. The underlying or the overriding reasons for buying gold early this year has not been removed. There is some talk about some rising rates in the US. We're not too concerned about that. Taper from the ECB may have a short-term negative impact, but overall the biggest negative potential driver for gold right now is the dollar. If that continues to strengthen, then gold will be struggling. But overall, we view that as a short to medium-term issue. Longer term, we still see gold at higher prices.